In this video, I'd like to use the textbook example exercise 2.1 to analyze some routine economic events to see how they impact our accounting equation. So we're going to look at the accounting equation using exercise 2.1 from the textbook. I have reprinted it in the chapter 2 outline. If you want to follow along from the outline, you'll also see it in the following PowerPoint slides. So if you downloaded the PowerPoint slides, you have them there. First, I want you to notice that I've expanded the accounting equation to show that owner's equity has two elements: paid in, or sometimes called contributed capital. That represents the increase in assets when a company issues new shares of stock. And we also have retained earnings. Retained earnings is where we record in owner's equity increases in assets or decreases in liabilities that are attributable to the earnings process, a company generating revenues that exceed expenses. So what I'm going to just show you the first example. So we have a first transaction is the company issued 30,000 shares of common stock in exchange for cash. The effect of that transaction is to increase our assets, of course the asset is cash, and increase our paid-in capital, common stock. Now, why aren't we talking about debits and credits and journal entries? What we'll see is as transactions get more complicated, you have to avoid the trap of saying, what account do I debit or what account do I credit, or trying to just memorize journal entries. Fundamentally, what we're always trying to do when we encounter a new transaction is think about how it impacts the accounting equation. Because once we know what kind of account went up or went down, an asset liability, we'll find that the rules for, quote, debit and credit, or how we record increases and decreases, everything just falls into place. So when you have an unfamiliar situation, rather than asking what's the journal entry, we have to do a step back and say, what happened? Have assets gone up or down? Have liabilities changed? Is this a revenue transaction? We'll see if we say, yes, it's revenue, then I have to be able to identify which asset has increased or which liability has decreased. So what I'd like you to do now is stop the video, work through the rest of exercise 2.1. Then you can start the video and check your answers to my solutions with an explanation. So let's get going. Like I said, stop the video, and then when you start it up again, I will work through the various examples, starting with the next PowerPoint slide. So the first transaction is that the company purchased equipment at a cost of $40,000. And equipment is an asset, and so our assets would increase, and we would record that accordingly. And we would, if I was really going to label it, I guess I would call it equipment. We're also told that the company paid cash of $10,000. So I should have had a little more space here because what we'll see what also happened on our asset side is, in addition to our equipment going up, we also have an asset going down. Then that would be a $10,000 decrease in cash. So I'll have to stick it up there. Okay. And the company issued a note payable, a liability, in the amount of $30,000. And so I can see in my accounting equation that we've kept everything in balance because the asset change, the company, is a net increase of $40,000, $30,000 equipment minus $10,000 cash, and we've had an increase in this is a liability of $30,000, and that would be called a note payable. The second transaction is purchased inventory on account at a cost of $90,000, And it says the company uses the perpetual inventory system. Don't worry about that too much right now. I think that's probably the only inventory system you know. But that's saying that an asset account inventory went up and when something is purchased on account, that means they didn't pay for it yet, and so they have a liability of $90,000. And that liability would be called accounts payable. It's not a note payable because they didn't sign a formal lending agreement. So that would be we would still be in balance. Number 3, credit sales for the month totaled $120,000. That means that they had not collected cash yet, but they have a claim to be paid. And so our assets would increase. We would call that asset, by the way, accounts receivable. I hope all this is coming back to you. Because they have a claim to be paid, and we're going to recognize the revenue of $120,000. That's going to increase our retained earnings. That's the revenue side. Now, they gave something up. Inventory decreased by a cost of $70,000. And so we've got accounts receivable going up, we have inventory going down. And that cost offsets a portion of our revenue. What we can see is based on how this transaction worked is that our net increase in assets is $50,000, and our net increase in retained earnings is $50,000. So we've had an increase in our assets. We have an increase in our assets of $50,000, and our earned capital, which is represented by this account called retained earnings, is $50,000. Continuing on, the next transaction is they paid $5,000 in rent on a warehouse building for the month of March. So anytime I see the word paid, I know that cash decreased by $5,000. And there's no lasting benefit. This is just 1 month's rent, so there's no offsetting increase in assets. And so what we would see is our retained earnings would decrease as a result of this expense. However, in number 6, they again paid $6,000 in cash. So cash went down. But now what they paid for is a 1-year fire and liability insurance policy that's going to begin in April. It's going to begin in the next month. And so what we say is that $6,000, what did they get on the other side? They actually got an asset. We're going to call it, they prepaid their insurance. They have insurance coverage now for 12 months. And so on this payment, they got something of lasting benefit. As I think I said earlier, whenever a company writes a check, fundamental question is, what did they get for it? Is it an asset, or is it just something that, like in number 5, that benefits a single period? Then in 7, they paid $70,000 on account for the merchandise they'd purchased. So their asset cash decreased by $70,000. But on the other side of my accounting equation, the accounts payable also decreased. In 8, they collected $55,000 from customers on account, so their asset cash went up by $55,000. But the other thing that happened was they had set up an accounts receivable when the sale occurred, and so although cash goes up, accounts receivable decreases by the same dollar amount. So as a result of this transaction, the composition of their assets, put that extra zero in, the composition of their assets has changed, but total assets have not changed. And finally, this is the one I always wish they had not put in. We're told that they recorded depreciation expense in the amount of $1,000 for the month on equipment. Now, the word expense tells me right away that there's been a decrease in my retained earnings as a result of this expense transaction. What's on the other side? Depreciation is an allocation of the equipment cost. In other words, equipment doesn't last forever. Maybe you remember this from your Principles of Accounting course. And so over time, we allocate the cost of the equipment to an expense, which means that we reduce the balance in our equipment account. But for various reasons, the reduction, and we'll look at this when we look at journal entries, rather than being directly to the equipment account, goes to a funny account called accumulated depreciation. And we'll talk more about that later. Again, I kind of wish this entry had not been included in this particular exercise because we're not really ready to talk about cost allocation. So this is a look at exercise 2-1, a review of transaction analysis. If you have any questions about any of these entries, send me an email and I'll try to answer them.